All right, in today's video, we are going to have a ton of fun. We're going to look at several examples of front-loading a whole life insurance policy where the goal is maximizing the cash value. So specifically, what we will look at is first front-loading a policy. What that means is that we're starting with a lump sum of cash. We want to start with a larger dollar amount, deposit it into the policy in day one, and have a very, very high upfront cash value. Number two, I want the ability to commit to a minimum premium that never feels like a burden. But then three, I want the option to add more money to the policy at leisure in order to continue to grow the cash value at a faster pace. So we'll begin with a 35-year-old individual who plans on starting with a $100,000 lump sum and then is committing to $4,000 per year thereafter. So let's take a look. What we've got first is exactly what we just discussed. $100K lump sum, that's how much he's starting the policy with on day one. $100,000. First year cash value, about 94%. So you've got $94,000. That's on a guaranteed and non-guaranteed basis. And then we've got $4,000 per year thereafter, indefinitely. He does not have to pay this indefinitely, but we ran this illustration assuming he just continues to pay the $4,000. What is highlighted in yellow represents the break-even point, which is when his cash value is equal to or greater than his total payments. So this is between years 3 and 4. This is a very attractive policy. The death benefit is reduced after the 7th year. That has to do with the MEC test on a policy and preventing a taxable event. That is a nice lever to pull if your goal is maximizing cash value and you do not want to aggressively fund the policy for a long period of time. Let's look at the next scenario here, or the next illustration, which is the exact same product, but what it looks like if he adds more. So we've got the lump sum, then what it looks like if he committed to the minimum, but what does it look like if he adds more at leisure? So his intent is to start with a $100K lump sum and then fund $30,000 per year up until the age of 50. And here we go. Very strong policy. Crossover point or break-even point, year 3 when we look at this example. And this, by the way, is the exact same policy, exact same company, product. It is just showing what the values may look like if he funds different amounts. If he funds the minimum or $30K per year, it could be in between. It could even be something like this, where he funds it up until age 40 or through age 40 and then says, you know what? I've had some life events or some life changes. I want to do other things with my money. I'm going to stop altogether. And the policy continues to grow. This is meant to demonstrate different moves you can make as time passes. So we do not need to commit to any of these up front. We're demonstrating starting a policy with a lump sum and then having a lot of flexibility as time passes. All right, so that's number one. Check it off. Number two, a 45-year-old male starting with a lump sum of $200,000 and then committing to $7,000 per year thereafter. So that is a heavy upfront amount considering the yearly minimum. Let us take a look, shall we? So next tab here, age 45 male, lump sum, $200,000 right out of the gates. And here we go. So I'm going to break this down a little bit here. $200K in the first year. First year cash value, just about $180,000. So you're close to 90% first year cash value in this example. You can get it closer to 95% by using a different version of this product. We talked about this in the detailed case study of this video. But what we've got here, the annual funding in this particular illustration is $50K per year. Ignore this for now. Here's his minimum commitment, $7K per year. So in the first year, he's got the $7K minimum, another $193,000 added to PUAs, for a total out-of-pocket of $200,000. Then year 2, what he is committed to is this, the $7,000. We're assuming this is paid, and then an additional $43,000. They do not need to be paid at the same time with this company. This can be paid at leisure, maybe some years it's 20. He's got a lot of flexibility here. But what this illustration was based on is funding $50K per year through the 10th year, but set up with flexibility showing here's what it looks like if you do get $50K in every year. But for your peace of mind and knowing what you will be billed for every year, it's $7,000. All the rest is gravy. Okay, that's great. So what if I don't get $50K in every year? here's a minimal amount. Again, committed to $7,000, but what he wanted to see here is a nice round number of $10K. So what we've got first year, the lump sum, which he already has available. This is going into the policy. First year cash value is identical in these two because, again, we've got the same policy here, but different funding assumptions. What does it look like if I only paid 10? What's it look like if I paid 50 every year, 3-year 10? But here we go, 10K per year. Still very strong upfront cash value and an early break-even point. The main reason why is because of that large lump sum upfront. And then here's something fun, depending on one's definition of fun. What we've got here, again, the exact same policy, but check this out. Year one, you're paying $200. How about the next 2 years? Look at the blue column. You're paying $10K per year. Then what happens? 50, then 10 a couple years, then 25 for several years, then 50. This is displaying what a policy might look like if we adjust the dollar amount as time passes. This is a great example of demonstrating flexibility because a lot of times people wonder, how flexible is a policy? You mean to tell me I can commit to $10,000, even $7,000, and then just add more money to the policy at discretion? Yes, you can do that. Depends on the company, product, and the PUA rules and such. We went through that in the specific case studies, but we can do that with this policy here. So again, we're demonstrating different funding options, all with the exact same policy. All right, so let's continue on here. We're going to check off our age 45 individual. Let's look at an age 50 individual. And what we've got here is a $1 million lump sum with no yearly minimum. So the goal here is to get $1 million into the policy, and then I'm done. I don't want to have to pay anything else in after I get that $1 million in. What we're going to look at specifically is paying it in 1 year, over 5 years, and then over 10 years. Which option is the best? Here we go. 1 year to the left. Very cash rich up front. 1 million goes in. First year cash value, almost 95%, $945,000 and change. He pays nothing in beginning year 2. The premium's still due here, but he's not paying for it. The policy is paying for itself through dividends and interest. Early break-even point, still year 4 in this particular example. Very high death benefit up front. That again has to do with the MEC treatment on a policy and preventing a modified endowment contract from occurring, which would result in a taxable event. All right, so question here, is this ideal or can it be optimized? It can be optimized. So what we've got next, look at this. Same out of pocket to you if you're this 50-year-old individual, but breaking it up over 5 years, $200,000 per year. Much less death benefit up front. Can actually divide that 15.7 by 5, and you get just about this. It's off by a slight amount, but we divided it by 5, and then max funded it for 5 consecutive years. What do you notice here? You've got more cash value, more than $100,000 20 years in. And again, same company, same product, same out of pocket to you, just a more efficient way of funding the policy. Then we looked at the same thing, but funding it for 10 years, not quite as attractive though when we look at those values long term. That's actually the weakest one. So if we compare the two on the left, because these are the two that were attractive, what we've got in purple, it's the 5-year option and showing how much more or less we have in cash value with the 5-year option compared to the 1-year option. So the 5-year is the winner. For this particular example, an age 50 male, the sweet spot is going to be between a 3 and 4 pay when we look at it on a guaranteed and non-guaranteed basis. But taking a front-loaded policy, or in this case, a lump sum of $1 million and looking to make it as efficient as possible, the winner was 5 years in this particular sample. Okay, another 50-year-old individual. He's looking to start with $150,000 and then commit to a minimum of about $11,000 per year. Let's take a look, shall we? Here we go. Number one, $150,000 up front and then the minimum thereafter. We said $11,000. I just rounded up there. The actual minimum on this illustration, $10,700 per year. Is this a good option? if you're going to get more money into the policy, if you feel that it's realistic that you can add just more than just the minimum, then yes. If it's just the minimum, I would actually spread this lump sum out over 2 years and reduce the minimum to closer to $5,000 or $6,000. But this is not bad, considering his plan is to do this. Add $50,000 to $100,000 per year. So he wants the ability to scale his funding up as the years pass, and he feels that his maximum could be as high as $100,000 per year. So, a 55-year-old individual. So this is a 55-year-old female who's looking to start a policy with a lump sum of $30,000 and then commit to $2,000 per year thereafter. Is that possible? And does it make sense to start with a $30K lump sum up front and then pay just $2K per year thereafter? Does it make sense is the question. Let us take a look, shall we? What we've got first is the $30,000 lump sum up front. Cash rich on day one. You fund 30, or she funds 30. You've got $28,000 immediately. Now you fund $2K per year. Break-even point, which is when your cash value is equal to or greater than your total payments between years 7 and 8. It's not that attractive. A policy can be designed to be much more cash rich upfront and long term. So if her plan, or if she feels that she'll only be able to pay the minimum after that lump sum, I would not recommend this particular design. However, if she feels she can add more to it, she thinks realistically I might be able to get $5,000 or $10,000 per year into the policy, then yes, this one is definitely much more attractive when I'm adding more money into PUAs. Because the minimum consists of what? The premium, term riders, a small amount toward PUAs. Everything above that minimum, we're funneling into PUAs, which will maximize the cash value. It'll also maximize your long-term death benefit when you study a policy. But back to the minimum example. If this is you and you looked at it and said, okay, I'm comfortable with $30K up front and then $2K per year thereafter. I want to do this, but I want the numbers to make sense for me. And I don't want to just force this situation. If I get 10 in, that's great, but I don't know how realistic it is. What I would do then is look at something like this. Here's the exact same out-of-pocket for her with the exact same policy. What's the difference? The out-of-pocket is spread out over the first 2 years, where we have 2 payments of $15,000, the same $2,000 per year thereafter. You'll notice for 1 year longer than the option to the left, because we wanted to get the same $50K in. She doesn't have to do that. But if we compare the values, let's look at year 12, where the same dollar amount is paid in. I've got about $1,200, almost $1,300 more. And the total amount you paid in is $50,000. Your break-even point is between years 4 and 5. So you have a much more cash-rich policy by spreading that lump sum out over the first and second year. And then we looked at the same thing where we pay in $10K per year if she feels she can do that. What we also looked at in the case study for this particular set of illustrations here is using this policy to clear off debt. She had about $25,000 in this example of debt she wanted to use the policy to pay off. We looked at this example, $15K years 1 and 2, and then $2K per year thereafter. We looked to fund the policy as we see here, then take a loan of $25,000, pay off the debt, then repay the policy loan. And what we looked at specifically is what was the yearly cash value growth compared to the yearly interest we were paying to the insurance company to make sure it made sense for us as a policyholder. Well, that was a fun case study. All right. And then the last one here, that's got to be red, not black. There we go. Red check marks. Age 55, we've got 1 million, making it efficient as well. There's a difference with this one and the 55-year-old individual. And here's the difference. What he wanted to do in the first year, start out with 500 grand and then pay 100K per year into the policy thereafter. So here's what it looked like. Again, the name of the game here is making the policy as efficient as possible. So what we've got, $500,000 deposited in year 1. Year 2, he adds 100. It's got positive growth at this point. How you can tell, year 1, you're at 443. He adds 100 to it. 100 plus 443 is 543. Yet his cash value is 552, meaning he got his 100 back and more on top of it. The more consists of the dividends and interest that he's receiving from the insurance company. Highlighted in yellow, break-even point at year 5, and he makes his last payment when he is 60 years old. So there's the $1 million that goes in. This strategy can absolutely work. We have seen individuals attracted to this type of setup. However, if this is me and I'm working with a total of $1 million, I would say, or I would want to see one other option that's a bit more efficient. So if you requested this from us, or if you requested this from your agent, what I would ask them specifically is there a different way this policy can be designed to give me more cash value and to give me more death benefit long-term? Meaning, can it be better than what I requested? Am I missing anything? Am I not asking the right questions? Here's why. Identical product, funding it differently. You'll notice that the death benefit is less to start. Start is the key word. There's your funding, $250 per year. Break-even point's the same, year 5. What's the difference here? Here's your cash value difference. This is going to show how much more or less you have in cash value with this option, option B, compared to option A. And what do we see? There's a difference over time. It's noticeable. This is the cash value difference. You'll see the same thing with the death benefit difference. If we look at year 20, 2.4, compared to almost 2.5. It's a $70,000 difference there, approximately. So we see more value in just looking at another scenario. This is something that I feel is beneficial to see up front and not find out after the fact, hey, why did I never see this option? Because I think I might have done that because I got more cash value and death benefit long term. Fun stuff, right? So I hope you enjoyed this. This was a ton of fun. If you'd like to see the mechanics and really understand how each of these situations were put together, how the policy was designed, all the ins and outs, and hear questions that people like this are asking when we're actually modeling plans like this for them, I would check out any of the detailed case studies as they provide a thorough overview there. But again, I do hope that this helped. Let us know if you have any questions at all, and thanks so much for watching. We do appreciate it. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.